Hi there, it's Doug here, coming live from sunny, but a little bit on the cold side, Vancouver, at least below zero, which is cold for us. I guess people in the prairies will probably laugh at me, but anyways, today on Stock Story, we're going to cover the area of stock picking, some of the analysis we do for revenues, earnings, and cash flow. We did talk about the balance sheet in the previous one, and I'll refer back to that a couple of times, but this is the operations, which actually increases the amount of the balance sheet. So it should be an interesting thing to look at. As a reminder, please, this is for education and entertainment and definitely not financial advice. If you get ideas from it, that's wonderful, but please do your own due diligence whenever you choose an investment, and if you need to, consult a professional. Anyways, I'm going to go back. This is the balance sheet that we looked at last time, and if you didn't see that one, it's stock picking, financial health of a company, and we went over basically. Oh, sorry, that's not the balance sheet. Okay, click. There we go. This is the balance sheet that we had from the previous one, and it sort of shows all the assets and the liabilities, and the assets minus the liabilities gives us the actual book value of a company, which is really what it's worth at that given moment. But when you're investing, you want to find a company whose business is growing, and so for it to grow, that equity, that book value has to keep growing. So there has to be an influx of cash coming into the balance sheet to and sales and that sort of thing to grow the balance sheet so that book value gets larger. So anyways, here's a simple income statement. So when we're looking at revenues and expenses and cash flows, there are two forms that are looked at. One is the income statement, and the other one is the cash flow statement. And I've done a very simplified version of an income statement, and then really for the cash flow, all I'm saying is I'm giving what some of the things that are different in the cash flow statement that are why you need to look at both, actually. So on the income statement, we have sales and we have expenses, and there's different types of sales. Some sales are on account, some are in cash, and so therefore this is one place where the cash flow statement could be different, is it doesn't recognize an accounts receivable as cash coming into the business, because there's not cash coming in until the people pay their account. So that's somewhere where the cash flow statement would then take away that as far as basically what would be considered income until it's actually paid for. On the expenses side, between the overhead cost plus the cost of actually producing whatever your service or your goods are, and then there's things like depreciation for your assets, and that's a calculation. You're not necessarily spending the money out. Someday down the road, you may have to replace the building or a vehicle or something, but in the meantime, you're still charging the I guess the depreciation of the asset to the current period, which then will bring your net income down. Now on the cash flow statement, because no cash went out, you're going to have to add that back in as cash because it's not cash going out. So those are two big differences. You can have you can have two situations. You can have net income, where you have positive net income, where your revenue is above your expenses, but then have negative cash flow. Or you can have the other way around, where you have negative earnings and you have positive cash flows. And the reason for that is, in this example, where we have $50,000 in sales, we remove the receivables. So in the cash flow statement, and as a result, that would be only $20,000 or $30,000. The cash portion of the sales would be the only thing that was a plus. On the other side, the depreciation was $3,000, so we have to add that back in. So in the end, if you take a look at it, there was $10,000 net income, but we took out $20,000 of the revenue. We added in $3,000 for the depreciation. As a result, we took the $10,000 minus the $20,000 plus 3,000, and we actually get a negative cash flow of 7,000. And this can be very interesting from different types of investments. Like for an equity, you might see that it's got negative earnings, but you see it's got positive cash flows, and that can mean different things. One, it can mean their dividend is safe, so you don't have to worry about that. And if they got a strong balance sheet, they may be just in a short-term kind of thing. And if you look at the cash flow statement, you might find, or if you look at both statements, you might find that there's certain one-time things that are the reason for maybe a downturn or whatever. And so sometimes you can tell by looking at the two statements and what's on them, you can see that it's a temporary situation. And you can also see something like there's examples where like when the oil and gas industry or when the price of oil went down to like 40 some odd dollars a barrel, all the stocks were dropping. And one of the other ways you can invest in a company is by lending it money through bonds or debentures. And so I did see a company that I was following called Transglobe, and they, like a lot of companies, because the oil prices have gone down, they were showing negative net income. And so right away, that also meant that their debenture, the value of it was going down. So it was at about a 20-25% discount, plus it was paying 6%. So there was around 26 to 31% available if you bought that debenture, as long as the company could pay it off. Now they had, looking at the balance sheet, as we did in the previous video, I saw they had lots of cash to debt. So they had lots of cash to cover their debt. So that was a good sign. The other thing was, even though they had negative earnings, there was lots of depreciation being charged off of the revenues, and there was actually cash there. So once again, then that also meant that they actually had a positive cash flow. So they had a strong cash to debt position, and they had a strong cash flow, which made me feel very comfortable that even though their debentures were selling at a discount, that they could easily pay them off. So that's one of the areas where you could possibly do something like that. Now, so I look at a number of different things, and here's Air Canada. I'm going to do the two airlines, and then Johnson & Johnson, Procter & Gamble, just to be consistent with some of the other ones that I've done. There's all sorts of different things out there, and you'll see that when later on in future videos, when I start looking at certain stocks I might be considering buying and stuff. Anyways, if you look at Air Canada, or if you look at any stock, I want to know that they've got some reasonable operating margins and net margins. Certain businesses lend themselves to larger margins than others, like software has bigger margins than, say, automotive or airlines, where the capital costs are very high. But anyways, so they have pretty decent margins here. Now, usually the next line would not be ROA, which is return on assets. It would be ROE, which would be return on equity. But as we saw up here, the tangible book value of Air Canada is negative. And because of that, there's no return on equity, because there's not a positive equity. And that is the main reason why I have chosen to invest myself in WestJet over Air Canada, even though Air Canada is charging, or it's the price is at a very low price to earnings ratio, and as a result, there's been a lot of people flocking into it because they do have pretty good earnings, considering how low they're being, how low the stock price is for that. However, that fact that return on equity is missing tells a story as to why I'm not as big on it. The return on assets is pretty good. The return on capital is very good, 16%. When you're looking at, well, I'll show you when we get into WestJet, because they do have a return on equity. The revenue growth is 2.7, not strong, but it's growing. And that to me is very important. When earnings grow, it can be because people have cut costs. But when revenue grows, it means one of two things. It means they've sold more product and service, or they've sold the same amount of product service, but they've been able to raise their prices. And both show that they've got competitive advantages in their industry. And that's really an important thing to me. So they have 2.7% revenue growth over the last 3 years. not outstanding, but it's better than if that's negative, then I start to think, okay, is this business losing some of their competitive advantage in their industry? And their earnings per share growth is very good. As you can see here, it's 12.3%. That's very good. One of the other things, when I talked about earnings or income statement versus cash flow, price to earnings, that's basically the price of the stock as a ratio to the actual earnings per share. So it's the price per share to the earnings per share that comes off of the income statement. Over here, we have the price of the operating cash flow. So this is not the total free cash flow, but it's the operating cash flow. Airlines, because of their capital expenditures on buying planes, and WestJet's in the same situation right now, are not showing a free cash flow at this moment. They may over the next year or so, now that I believe they've bought or they've replaced some of their obsolete planes. But you can see that it's less, and that would be from things like the depreciation being added back in, that sort of thing. So you can see sometimes there's more cash coming in than the earnings actually say, and sometimes it's vice versa, just depending on depending on the situation. And these are the things that we look into. And when I go into other specifics, when I'm actually looking at a company I'm considering buying, I'll talk a little more about that. When we go to WestJet, you'll see they have good operating margins. They have a 15% return on equity, which is what Air Canada didn't have. 15% is good. If you want to beat the market, you really want a company that's getting a return on equity, because equity, remember, is the same as book value. So if you're getting a return on your book value, that's 15%, then effectively your stock, that should mean an appreciation of about 15% in the stock value as well, because the actual value of the company's gone up by 15%. Since the stock market is more 8-9% type of return, 15% is a significant upside over what the general indexes do. And so Warren Buffett tends to like a good, strong return on equity, and I always keep an eye on it to make sure. I have sometimes sifted out some companies if they have single digits, like if their return on equity is less than what markets generally grow at. It's a tendency for me to move away from it unless I have some information that's really important. So the return on assets, return on capital, I think they're even a little bit less than Air Canada's was. I'll just take a look at that again. Yeah, Air Canada had a little bit more return on assets and return on capital, but because they have a weak balance sheet, they don't have a return on equity. And the revenue growth and earnings growth are higher for WestJet. And these are the averages for the past 3 years, as you can see right here. Once again, we look at the price to earnings is 9.27, but the price to operational cash flow is 3.54. Now, I'm going to move on to the drug companies. Oops. Okay, you can go away now. Anyways, I'm going to look at the drug companies, and hopefully they will show a price to free cash flow that we can work with. So, okay, so this one is Johnson & Johnson, and once again, you have a really strong operating margins. They have a different type of business than the airlines, and as a result, their margins are much higher. Look at how high that return on equity is. That is phenomenal. The only reason I don't own Johnson & Johnson is because of the price of the stock is on the high side now. If there was a major correction and it brought Johnson & Johnson's price down, like 2007, 2008, would have been a wonderful time to buy into this company. You would have got it with over 5% dividend with very low price to earnings ratio, and it would have just been a huge opportunity. But these opportunities will come around again at some time. We don't know when, but when it does, I would probably scoop up this company. You're going to see the return on capital is over 100%. Like this is phenomenal. Revenue growth is slow, but in a big company like Johnson & Johnson, you know, just that it's growing is still a good thing. Earnings are growing, so that's all good. When you come down here, you can see that the price to earnings, so the price of the stock to the earnings from the income statement is 20 times, which for a company that's not growing 20% a year is a little bit on the expensive side. Although it does say the forward P is 15, but that's still high compared to this growth rate. Now, when we go down into here, you see the price to operational cash flow is lower, just like the other ones. But you see the price to free cash flow is not. So they aren't actually, they're actually more overvalued because the free cash flow that's coming in is even a little bit weaker than what the earnings say. Now, when you do analysis of one of these things, we actually go right into them, and I will do that when I focus on individual stocks in the future, and I will show a little more detail on what we'll do, a little bit of forensic work to try and find out why the free cash flow is different. Sometimes you get where the price to earnings and the price to cash flows are the same, which basically means that there's no discrepancies in it, and it's a pretty steady situation, right? So let's look at Procter & Gamble. Still got good margins, not quite as good as Johnson & Johnson. They still have a good return on equity. Still, this is another very good company. The numbers aren't quite as good as Johnson & Johnson, but this is the problem here is their revenue growth is declining. So from a long-term standpoint, that could mean some weakening in their advantage or their status excuse me, within their industry. So anyways, on the price to earnings, they're 22.46, and both their cash flows are lower. So that means whether it's depreciation or other factors that are coming in, you know that they do have cash flow coming in. Once again, no, this is very expensive, especially for a company that's got their earnings per share and everything, and their revenues are decreasing. But anyways, that is sort of what I look for in the earnings, and I'm looking for something that's going to, as I say, bring the balance sheet and get that equity or book value and increase it. So it's cash coming into the business that's going to expand the size of the business, so the value of the business gets bigger. And in theory, eventually in the long term, the stock market will follow what the value of the business is. In the short term, people get excited by all sorts of things: speculation, belief that somebody's going to invent the newest drug or the newest technology and that. But in the long term, those ones only come out if the prediction is right. In this particular situation, if you get something that's got good earnings, that's growing its balance sheet, and you bought it at a fair price to its balance sheet or close to its balance sheet and its earnings, then over time the stock market should come to that same realization. So we have back at Stock Story, the information that's in this is in the 7 points of due diligence to improve risk and reward ratio. Thought I'd just share with you too. So far this year, I'm in the negative. I don't worry about things on the short term. Right now, the S&P and Toronto Stock Exchange are up over 1%, and I'm down 0.16%. As you can see over here, though, my average in the last 5 years has not been bad. It's close to the S&P, and it's much better than Toronto Stock Exchange for 5 years. I've been doing this while holding a lot of cash and not being fully invested, so I feel these are pretty good results. Anyhow, that's the area on revenues, earnings, and cash flows. Feel free to subscribe to my channel. Share this with anyone you like. I'd love to see your comments down below, and please like it if you enjoyed this. We'll see you in the next video.